Hey guys, welcome to the channel. In this video, we will be talking about market and limit orders. We will see what are they and what are the difference between them. So whenever you want to buy or sell in stock market, you can do that transaction by using two different approaches. One approach is that you will say, I want to buy or sell, or I want to perform this transaction and I want to do it at whatever the best price that is available in the market. In order to do this approach, we use something called as market order. So when you place a market buy order, you are saying that I want to buy this instrument at whatever the best price at which someone is selling in the market. Similarly, when you place a market sell order, you are saying that I want to sell this instrument at whatever the best price at which someone is buying in the market. The second approach is that you can say, I want to perform this transaction or I want to buy or sell this instrument at a specific price. So in order to perform the transaction by using this approach, we use something called as a limit order. So when you place a limit buy order, you are saying that I want to buy this instrument and this is the best price that I can pay. If anyone is willing to sell me at this particular price or any price better than this, then only I will buy. Similarly, when you place a sell limit order, you are saying that I want to sell this instrument at this price. If anyone is willing to buy at this price or any price better than this, then only I want to sell. So here what I have is an image of the market depth where we can see the buy and sell limit orders. So here if you look at this, then this is the instrument and this is the last traded price. And then here this left hand side is called as the bid, where we can find the limit buy orders placed by the traders, and this right hand side is called as the ask, and here we can find the limit sell orders placed by the traders. For example, if we look at this limit buy order, someone who has placed this order is saying that I want to buy Bank Nifty futures May contract and I want to buy one lot, which is 15 quantity, and I want to buy at this particular price. If anyone is willing to sell me at this particular price or any price better than this, which will be a price less than this price, then I will buy. Similarly, if we look at this particular limit sell order, here we can find two orders of 45 quantities at this particular price point. Whoever placed this order is saying that I want to sell this Bank Nifty future at this particular price, and if anyone is willing to buy at this particular price or any price better than this, then I want to sell. So if you look at this situation in here, if everyone starts placing the limit orders, then what happens? The transactions will not happen. Why? Because no one is willing to pay the extra to perform the transaction. So in this case, if only limit orders were present, then the transactions will not happen. The price will not move. So in this situation, if a market buy order comes, and when we see a market buy order, the trader is saying that I want to buy certain quantity of this particular contract at whatever the best price at which someone is selling in the market. So let us say someone places a market buy order for 45 quantity. Then what happens is the best price at which this particular instrument is available right now for sell is this. So that particular trader who has placed the market buy order will get this particular price and his order will be completed. Similarly, in this situation, if we see a market sell order for, let us say, 30 quantities, then what happens? So when a trader places the market sell order for 30 quantity, He is saying that I want to sell 30 quantity of this particular instrument at whatever the best price someone is willing to pay. So here, if we look at this, 15 quantity is available in the market at this particular price. So here, this particular trader who is willing to buy at this particular price will get 15 quantity. Then the remaining quantity will be for this particular order and for this particular trader. Whoever placed the market sell order for 30 quantity, his order will be completed, and the traders who placed these limit orders will get those contracts. Okay, now let us see the difference between the market and limit orders. As you have seen here, when a trader places the market order, the main intention is to perform that transaction. Whether he is buying or selling, the main intention is to complete the transaction, and he is not concerned about the price that he is getting. So when a trader places the market order in order to complete his transaction, what happens is sometimes the trader has to pay a bit more than whatever the last price at which the trade has happened. And we call this as the slippage. So if he is buying, then he has to pay a bit more. If he is selling, then he has to sell at a bit less. So slippage is the one issue. Now this slippage amount will depend on the amount of lots a trader trades and also the liquidity on the market. If more traders are trading the instrument, then there will be more number of orders, and at that time the gap between the latest price that is available in the market and the transaction where the last trade happened, that gap will be less and the slippage will be less. Now when the trader uses the market order, the transaction will be completed for sure. If the trading is happening in the instrument, then the transaction will be completed. Now if we talk about the limit orders, then when a trader places a limit order, there is no guarantee that that order will be completed, because only if someone is willing to sell at this price or buy at that price, then only the transaction can happen. So if no one is willing to do that, then the transaction will not happen. So when you place the limit order, there is no guarantee that the trade will happen. And also when you see the orders in the order book or market depth, there is the possibility that the traders can cancel that also. So when you place a market order, you can't cancel that, or you can't change the decision after placing the order. But when you place the limit orders, you can change your mind and you can either cancel the order or you can modify that. So that is one advantage available in limit orders. So what moves the market are the market orders, and the liquidity is provided by the limit orders. In order flow analysis, we give importance to the market orders because the market orders move the market. As we have discussed before, if everyone places limit orders, then the trading will not happen. And in order for the trading to happen, the price to move, traders has to come with the market orders. So this is it guys for this particular video about the limit and market orders. If you like the video, hit the like button. If you don't like it, hit the dislike button. If you have anything to say, then write that in the comment box. For more tutorials like this, subscribe to the channel.